Hello, thanks for tuning into this episode. Before we start, FinTech Focus TV is brought to you by Harrington Starr, global leaders in financial technology recruitment. Head to the Harrington Starr website and check the links below so you can download the latest copy of the Financial Technologist magazine. And also, we've got the TradFi and DeFi Era of Convergence documentary coming up. If you're interested in the merger of the two, please get in touch. Thanks a lot and enjoy the show. Hello and welcome to another episode of FinTech Focus TV with me, Toby. Today I am delighted to welcome into the studio Devin Kohli from Alpha VC. Easy for me to say, wasn't it? How are you?
Very well, thank you, Toby. How are you doing?
Really good, thanks. Really good. Look, I'm really excited about this one because it's a subject which I really love talking about first and foremost, and we're going to get into loads of different things that I think is going to be really, really valuable to people watching at home. But before we get into all of that, tell us a little bit about yourself and your journey and Outward VC.
Yeah, sure. So I'm one of the general partners at Outward VC. We're an early stage fintech fund focused on sort of the late seed to Series B space. Our definition of fintech is very broad.
Yeah, well, this is an interesting thing, isn't it?
B2B, not just payments, which a lot of people associate when they think of fintech.
Absolutely.
They think payments, but we do capital markets, legal tech, reg tech, etc.
Do you have a lean anywhere?
We don't. We actually cover. We try and pick category winners in each of those sub verticals. We are a first time fund.
Yeah.
So our backers in the fund are Investec,
yeah.
Which is where I started my career for 14 years before that, advising tech companies. So Investec is an LP, Blackstone through NIBC, one of the banks they own is another LP, and then a load of family offices as well. And we set it up in 2017-18, and we launched a fund in 2019. So we're now 3 and a bit years in.
So just pre the storm.
But we're now in Fund 1, targeted 20 companies. We're in about 17. We're about to do 2 more. So we're coming up to the end of Fund 1 and shortly to get going on Fund 2.
And this is why I'm so excited about this. There's going to be a lot to unpack.
Yeah.
And all that as well. But let's go back to that. So you said you were at Investec for 14 years.
Yeah.
What prompted this to be your vocation?
So it is quite an entrepreneurial journey. So we, at Investec, which is a first-time entrepreneur bank in the sense the guys who founded it up till 2019 ran it. So they understood what it was like to be an entrepreneur and built it from nothing. I was working for them, advising fast-growing companies, both in the UK and in Asia, and then started to get the bank interested in venture capital from an investment perspective rather than an advisory perspective. And we set up some baby funds, which were invested very early in, and that was first money into some fintechs even in the UK like Curve and others. And then on the back of that, sort of my interest grew and grew and grew. And to be fair, Investec went and gave us the freedom to set up Outward. They went, look, this is actually very interesting what you guys are doing, what you want to do. Go and build a business plan. We'll back you into it. We don't want to be the only money in it. So go and find some other backers. And fast forward a few years, we built it, we've got some other backers, and we've got a fund, and Investec and us have a very special relationship.
Yeah.
Today, in fact, we actually are in their offices and allow for connectivity there.
Okay, it's amazing, isn't it? I think there's certain institutions like that I think have always been very supportive of growth, and Investec certainly fits that category from everything I know about.
Yeah, indeed.
So it's a natural progression. It was always going to happen. It's fate.
Yeah, except we never wanted to be. I think there's a big difference in the market with corporate venture capital, and we're not that, right? We're not trying to invest in something for strategic reasons of some of our LPs, whether it's Blackstone or Investec. This is a financial return fund. Who do we think is going to win that market? Because they've got the best team, the best product, the best whatever. That's what we were looking at, rather than, doing it for strategic reasons of our LPs. And I think, but for banks, like the big banks on the high street, they invest not necessarily for financial return. They invest because they want to see a link up with some of their product areas or whatever it is. So I think there is a difference. Outward was set up very much to focus as a financial return fund.
Yeah. No, which I think is probably the right thing to be looking at.
Yeah.
When if you think about the responsibility of the whole area. So let's come back to another thing you said. It's first time fund, and I've seen numerous different people go into this, and you see different success stories around that, because there's a lot of bumps in the road. Tell us about your experience as a first-time fund and how that went for you.
I think,
or is going.
The performance is going very well. We're very happy with how things are. I think anyone who goes on an entrepreneurial journey, it's never smooth sailing.
Yeah.
And I think setting up a fund from scratch, never easy. You've got hiring considerations, regulatory considerations. I mean, obviously you've got people backing you with capital for 10 years, right? Like that's a big commitment and a responsibility. It helped that we had two very large institutions going, look, we back these guys. And I think that helped get others to back us. And I think the proof's in the pudding. So far, I think everyone's been very happy with how things have gone. But I think it is that step into the unknown when you go for it. Because you don't know how is it going to be received. Are we going to be picking companies? We can only do our best. I think we can only also try our best for the companies that we invest in. So a big part of what Outward lives by is the value add piece.
Yeah.
I know a lot of venture capital funds say, oh, we add a lot of value. I think we deliberately pride ourselves on that point. And, I think our founders would reciprocate and say that. We're going to try to build these guys and help build them into winners. Of course, there are more problems than LinkedIn may imply, as there often is. But I think, it's been a great journey for everyone. I think also personal growth-wise for everyone in the team.
There's a really interesting piece you put in there about value add, because you're right. I don't think there's a company in there who doesn't say they're going to add value when you push it out there. But you're right also in the fact that not everyone does. There are so many companies there that come in there and it's almost a parasitic master-servant sort of relationship. And you hear horror stories. And we spoke beforehand about the sort of failure rate at Series A. And I think a lot of it is around that sort of, right, we're here, it's a punt, as opposed to anything that's really thought out. That's a massive generalization, but I think there's a lot of irresponsibility around where money's put and then the relationship that comes there afterwards. How do you measure value add, and what does that actually look like?
Yeah, so I think we look at value add. If the ask is, come and help us run the business, that's not the team we want to be backing, right? The question is, how can we supercharge your growth in 4 or 5 different ways? And I think for us, we look at our own network, opening doors on the commercial side or on the fundraising side. So I think on at least 6 or 7 of our portfolio, we've actually introduced them to their next round of funders. So our validation as a fintech fund early on attracts more generalist funds later on.
Got it.
And I think that's important. I think where they need hires and where we can see and identify gaps in the leadership team or not even in the leadership team is relevant. I think international expansion, regulatory.
And that's helping them with international.
Yeah, so a lot of, through the network of our LPs and through our own personnel, that we can get them into or assist them with partners in, say, the Far East or India or the US or wherever it is. I think governance, that's often not people don't realize that it's a startup, it doesn't really need governance. Actually, as they grow, the growing pains become more of an issue. Making sure, like, for example, very topically recently, trying to ensure there is a balance between cash burn and ensuring that salaries meet cost of living impact. Founders, how they work together as co-founders. It sometimes, as they grow, the friction, but also the roles, who's doing what. We need to have. So I think reporting, it's not, when a startup starts its journey, it's often like, oh, we'll check in once every 6-7 months with our angel investors. I think now it's much more sort of robust reporting so that they get used to the fact that they're a scale up and they're building a bigger business. All these different areas I think are important. And then it's great that we have big partners behind us who can validate a lot of the technology with us. So take Monets, for example, in one of our portfolio, just to give you color, I always think it's good to use examples. They claim to open a bank account in 120 seconds for anyone. Now that ability to onboard someone in 120 seconds is quite a powerful statement. We needed to check not only the tech stack, but obviously we have a bank as one of our LPs who don't onboard people in 120 seconds. So what's different? Well, how can they how did they work with the FCA to do this, et cetera, et cetera. That was very useful for us in tech validation. And I think we can
then use to them, I imagine, as well.
Yeah, we spoke to the regulator, we spoke to the bank. So that diligence piece is very useful to help a company, and also then for future funding, the diligence work that we've been able to do can be shared. And also during corporate action. So a lot of us have got a corporate finance background. So when an M&A deal is on the cards or there's an exit, etc., we actually work very closely with the management teams to structure the right solution. So there's different aspects across a company's journey which we try and really emphasize on. And I think the other thing is when something goes wrong, we'd like to always be the first call, even though we might not be the biggest shareholder. One example.
How do you make that happen?
Well, I think it's the relationship with the founders, right? Because you're in early, you've built that relationship early. You often led the Series A or the late seed round. You're on the board. most decisions aren't made in a board, as one probably knows, but they're made as you go. But you always maintain a constant dialogue with them, and I think that's something which then they feel it's a safe space to talk to you about whatever problem there is. When Curve went 2 years ago, when the Wirecard debacle blew up, Curve was using Wirecard as its payment processor. Who is the first call? It was us. There is like, look, I'm in the middle of a Series C fundraise. Yeah. He has actually written a blog on it, founder of Curve. Like, what do I do? Like, we need to sort this out, and can you help? And actually we did activate a bank to provide settlement and safeguarding accounts for him overnight, which meant that the business could only go down for 60 hours rather than 6 weeks, which some others went down for. And if you're a financial product and your product doesn't work, for a weekend, just about okay. For 6 weeks, you're gone. So that's the type of stuff we want to be able to help them on. It's the material things which they know they can come to us.
Yeah. So it's much more of a relationship than just a sort of financial transaction. And,
it's definitely
sitting there with on a high horse and asking for numbers and.
That's the wrong way. I think for us, it's very much like VC is a very relationship-driven business, and I think investing as well, because you're not just investing in the product, you're investing in the team. And we've always had a very high weightage on the team, because often you can find a problem and solve it, but that solution may need to pivot, and you need to have the brains and the skill set and the also nimbleness of a team to be able to this actually isn't working, we need to redirect this way. And that's where emphasis on the team of getting out of a hole collectively is something we really put a lot of value on when we're assessing an investment.
And how do you analyse that team? Because I think there's a lot, whenever I speak to anyone in investment, it will be the team's the fundamental part of it, then obviously the potential market size and scale, then all the other numbers behind it. But team's always first thing. And as someone who's worked in the people industry for the last 25 odd years, I kind of recognise how difficult it is sometimes to work beyond the veneer of that. There's a lot of smiling faces, like you said, look at the behind the story of LinkedIn at various different stages and understand that. How do you assess those teams where you think, right, that's going to be someone there who we can click with, who we can add value to, who are the right people, who've got that same ambition and are on the same page for us? Because I think it's really important for both parties in that, right?
Yeah, I think there's different levels of things we look for. It's first of all, do they have clarity of thought of what the strategy is and what the mission is of the company? Then it's, are they also, I guess, humble enough to know what they don't know, which a lot of people don't say. And I think it's okay, look, I've thought of this problem, but I, to be honest, don't know, and this is why I'm looking to hire in here and here and here. I think that's much more of an honest view rather than I've got the answers to everything.
And I imagine when people are trying to do that, they're trying to impress as well.
Yes, there's a balance, right? You want to be able to have clarity of thought, but also know that. So I think knowing what you don't know, also where, if there's co-founders, where the different skill sets lie. Yeah. Is one more operationally weighted, one is more technically weighted. And I think also how good are they at selling their own business, right? In terms of not selling the actual practical thing of selling the company, but selling the story. So you've got to look at all of this, because you can sell a story very well, but you don't have the operational understanding, or you don't have the humbleness to know that you're lacking in these areas. That's a recipe for disaster. But also, likewise, you could be very technically strong, but you're never able to sell the business to future rounds of investment and to understand, for people to cut through a very complex issue, like take data privacy, and these are not sexy topics, right? But you've got to be able to cut through the noise and go, this is my solution, and this is why we think it's going to work, and these are the metrics which we should be judged on. And that's not often an easy skill. So I think those are things we look for. Fundamental to all of that, if you look at the most successful founders in our portfolio, there's obviously a mission, there's all the things we talk about. It's grit, because like every day you're firefighting on an issue, and sometimes it can just, I've got a hire, I've got a financial issue coming up, I haven't done the R&D tax credit, or whatever it is. And as a startup, the CEO is pretty much doing 5 or 6 different roles. So have you got the grit to do that? And that's a subjective.
And what's the measure of grit? Yeah, it's subjective.
It's very subjective, but I think you've realised how much they want this, how much they want this, how much are they sweating for this, and it's not just how much money they're themselves putting in or put in, and it's where they are in their life journey as well. It's also how much you can kind of get an assessment of how much they're prepared to fight for this. Yeah.
And that's through conversation and relationship.
Yeah.
I mean, how long does it take for that relationship to bond? I mean, and of course, you're doing a lot of that in your growth online. I'd imagine at the start of it through 2020.
Yeah, so I mean, we started investing in 2019. In fact, earlier, as one of our LPs gave us a front commitment, so some of our portfolio goes from 2018, 17. But yeah, when 2020 hit and COVID, we actually did the first few investments during COVID without meeting the founders in person, which then you have to go through the whole, can we go? And I think the 2 or 3, we tried to meet them in the park for a walk, or we found ways, but I feel
that was a really interesting time for you.
Yeah, all of us. We made about 4 or 5 investments during that period, and had to spend a disproportionately more amount of time assessing them.
So did you think at that stage hold back? Because there was all that rhetoric when Sequoia sort of came out very early, didn't they, and say burn everything, hold. And I think it was probably my gut on that has always been there was a strategic play from Sequoia to do that, which suited which may or may not have suited them. But I think there was there was the rhetoric out there to hold firm. What was your take during that period?
I think we realised the move to digital would accelerate. I think for enterprise sales would slow. So B2B businesses, obviously, everyone's dealing with a pandemic. Half the people are not, and most people aren't in the office. So certain business models would struggle, and therefore you need to keep them alive with cash. But I think overall we felt that this was, we were early on in our fund life. We kept seeing great opportunities. I mean, to give you some numbers, we see around 70 companies a month.
Okay.
Which fit our criteria of what we look for.
Wow.
And so we're trying to filter that down to sort of 1 every 6 to 8 weeks that we invest in. It's quite a big process.
Yeah.
If we're still seeing good companies, we shouldn't hold back on investing regardless of the fact that people are locked up in their home.
There's a quote I love, which is that good companies should always be able to attract investment no matter what the scenarios. And I think that's sort of, as we move now to the latest crisis, we're still in that same sort of thing. My gut is there's a lot of institutional cash that's still there, and there's a lot of good companies at the same sort of stage. And I'm really pleased to see a few who I'm very fond of who've just raised at decent levels for Series B and Series C recently. And I think that sort of maintains the whole focus that good means good. So get behind it no matter what the climate. But I'm really interested when you say that. So it's 70 companies that you're seeing a month, and it's once every 6 to 8 weeks that you're making investments. So it's quite a big burn rate there. So realistically, you're looking at 1 in 100 that really will make the mark.
But we have to be quiet. I think I mean, for some,
and I can imagine there's a sublime and the ridiculous in that at the same time.
I think if you take sort of top of the funnel 70, and then you go down and you spend time with, you discount quite a few initially after looking at what they're trying to do, because we're very conscious we are investing in a competitor. We don't think the market's big enough. The structure of the deal doesn't necessarily make sense for us. So you sort of filter down,
process.
And then you get to spend time with maybe 4 or 5 that you spend maybe a couple of meetings with. Some of the deal flow teams spend a bit of time with. And then if we've got high conviction, we write an internal memo before an investment committee, which asks key questions. Why does this product need to exist? Why do we think the team is going to win this market? What makes it special in terms of the team? Why does Outwick need to invest? I.e., how can we add value? So if it's a business which you feel we cannot help in any way, it might be a great business, but we shouldn't be investing in it, which goes back to your point of us being more of a passive investor. So we ask ourselves that if we, as a team collective, feel we've answered those sufficiently, get the whole team, or our team, to meet the team at the investment company that we're looking at. And then after that hour and a half, whatever it is, we form a very quick view. And that's the process that we go through. And everyone from the graduate to us will fire questions and come up with a collective.
Yeah, and it's working.
Well, it's working so far.
So far, so good.
Yeah.
You mentioned some really interesting stuff there about the volume of companies there, and I know you've spoken before about the sort of funding gap that exists, and that's a lot I know of the sort of reason for being about with VC full stop. Talk to us a little bit about that.
So when we looked at going down this journey, we realised there were very few early stage fintech funds focused just on the UK. And we felt that was surprising given the supply-demand dynamics. So in our estimation, there's about 1,700 companies trying to raise in the 2 to 5 million space. If you take pure play fintech funds who have capital either half or full dedicated to the UK, so they've invested in about 300 million in that stage, but there's 6 billion worth of demand. Right. So you've got some of the gaps being filled by generalist funds a little bit. Some of it's been filled a little bit by angels doing a bit later stage, or family office doing a bit later stage. or very infrequently some of the hedge funds, which we're all know doing earlier tickets. That latter bit, and I think some of the sort of family has dissipated.
Yeah.
So you've got an even bigger gap.
Yeah.
So for us, like, this is a very important sector which covers fintech covers actually breeds into all areas, whether it's health, tech, legal. It sort of is a conduit for everything. And the UK happens to be a market leader in this space for many different reasons.
And probably actually, despite all the flack recently, there's a fair amount of investment to get even further.
Right.
I see a lot of the things that the government's done, rightly or wrongly, are aimed at really fueling growth even more in the sector.
And the UK is not just a net financial services exporter, but a big fintech exporter. All these companies are going global. So we need to be continuing to back those businesses, the next generation of those businesses. So that's why Outward was set up, to try and really pick winners at the most difficult funding round. And if you take...
And you believe that this is the most difficult funding round?
It's not just validated by the numbers, the demand-supply gap, but also like the personal stories. Like, take one of our portfolio primary bid. They took 12 months to raise that series. We met them at month 11 or month 10 in their journey, and they'd gone around the market and no one understood that business model. I think it's due to a lot of the people they were speaking to were generalist investors who were looking for a SaaS recurring revenue model, right? They may also have a founder bias against people who've been working in financial services, because most people are, where's your operator? Where were you founding a business before? Whereas if you work in a hedge fund or working at a bank, what do you know? But take primary bid, it was a transactional business model. It wasn't recurring. It wasn't a simple SaaS business. And you needed people who probably understood corporate finance and understood how the markets work in a regulatory understanding of the market to see the opportunity. So we actually led that round.
And their story's been proven.
And they've done exceptionally well. Valban is another one, which recently sold to Carter. It was a 15-month journey for us. We invested, and 15 months later, they've been bought out at a great price. So, but again, that was a model which fund management solution, not easy for people to understand. I felt like if you are not in the space, if you don't have an understanding of those particular verticals, you'll struggle to invest in it, because you'll say, well, how big can this really be? And I think both of those, I think Monet's Curve, I think there's others where you speak to the founders and they're like, okay, every funding round is difficult, don't get me wrong, but that first bit to get us on the map properly was super difficult, 12 months. I think Norris at Monet's actually diarized how many no's he got. And he counted 1,000. He went to 1,000 funds and they said no.
So I think that's the interesting part, isn't it? It's a changing of difficulties. The difficult part there is the no. And 1,000 no's is never going to be easy for anyone's ego.
Yeah,
the best of the time. Yeah. But the second part of it in B seems to be just about the sheer amount of work that needs to come into that, doesn't it? And the loopholes and the legalities and the bankers and every single aspect of that sort of brings an extra layer of complexity around it. I think the whole thing's fascinating. I think people probably need a little bit more education about what needs to come into it and how they how they need to approach the solution in the first place, because I think there's probably a little bit of naivety when we're saying, right, we need to get that sort of cash, let's go after it. And those 1,000 no's can sometimes be brought down a hell of a lot more by having the right sort of
or also someone helping. When we go out with our portfolio for their next round after we've invested, we'll sit with them and go, I think you should probably speak to these guys. This list does not make sense for you. It's a waste of time. How many man hours and team hours are going around spending time on that?
Because it sucks the CEO straight out of the business and focuses purely on that particular
play, right?
Yeah.
Big problem, especially now.
I'm going to segue slightly on this, because it's something that's really interesting to me for someone there who's putting their money where their mouth is, so to speak, in this. I think it's a really interesting market, and I think there's a lot of opportunities in this market as we go into, we're shooting this at the end of 2022. 2023 has got so many unknowns that come into it, but within it, I think a plethora of opportunities at the same sort of stage, as we've seen at every part of every financial downturn or difficulty or macroeconomic situation. So when you're sat there and you're hedging your bets and thinking about, for want of a better expression than that, more technical expression, when you're looking at those investments, and you're thinking, right, these are areas of fintech that I think are going to be really important and where you're going to see some real growth over the next couple of years. Where's your bet on that?
So we try and look at things thematically. One or two areas that we've sort of spent a bit of time on, which actually are the precursors to our next couple of investments, is the whole home ownership space, right? Rising interest rates, inflation, you've got this double-edged sword. of how are people going to be able to afford to get on the housing ladder. Yes, the government's reduced stamp duty, but interest rate increases knock that. So is there an argument for a rent to own model where I actually own the property on day one, I'm renting though still in that property? This business model has started in the US and we're seeing that in the UK. We've actually met all of the companies trying to do this space. They're all quite early and we're about to make an investment in one of them.
Okay.
So that's something which,
it's exciting.
But we've done that very thematically, looking at the macro situation, looking at what's going on in other markets and saying, okay, is there the market for this in the UK? And I think our conclusion was yes. Then how do you mitigate a company like that in the market that we're going into, turbulent interest rates? In fact, do they have enough levers to protect themselves? And what type of structure would this take? So that's one. I think also another completely different area which goes down to a big focus of Fund One has been transparency, in just general transparency. Primary bid is treating people fairly when it comes to retail and institutional investors on a listed market. But another area which we feel is this whole buy now pay later story, which obviously Klarna has been the
Poster boys.
and villain. I think is there enough data there to make whoever's offering buy now pay later, and it's not a defensible model. Monzo's doing it now, and Curve will do it. Everyone else is doing it. So it's not a Klarna only story. Is there enough data to give you an assessment of that person? You're relying on very old and outdated credit referencing. So there should be a new model built, data tools to actually assess that. So that's another area we're going much more into. And I think with the rising macro problems, buy now, pay later will actually be quite a useful tool for some people as they go through the winter.
Yeah, I think there's a lot of opportunity, isn't there? What about capital markets?
So capital markets, primary bid was our big investment there, which we saw. I think obviously there's some new changes going on through the government reports on trying to make the UK, just not on the equity side, but also on the bond side, more attractive. So we're looking at a couple of opportunities there as well. I think we're waiting to see how certain regulations play out. I think open banking, we made an investment early in Bud where they're sort of linking up aggregation and personalization. It took a few years for open banking to be fully really understood by the market, what the implications are, but you're really starting to see that now. So yeah, I think regulatory changes will prompt a new wave of innovation, and it already is doing that.
Yeah, no, absolutely. I think that's that digitalization that we saw through 2020 and the benefits that came out of the difficulty is absolutely right. I could be talking about this for hours, and I know we've got a sort of cap to this show, but there's something else I want to talk about a little bit, which is again talking about positives from negatives, which are one of my favourite things to look at. We are in a sticky macroeconomic situation with a lot of uncertainty through it, but potentially that is a necessary correction from what we've been seeing over the last 18 months or so, where there's been some extraordinary valuations, some dangerous valuations, irresponsible valuations at various different stages. What went wrong over the last 12 months or so, and how does this time period allow us to get things right again?
What went wrong last year? I think it was the never-ending party. Right? I think it was, no one wants to be the first to leave on a good party. There was numerous factors, right? You had very low interest rate environment, a lot of dry powder for VC funds, new entrants to the market, be it hedge funds and others who are very fast moving and pushing up prices, particularly in the later stage growth rounds. A rush to IPO, so you could see exit opportunities pushing through. So all of that was going on for a couple of years. And then you had, sadly, a bit of a herd mentality, right? Like, oh, we've got to go into this area and make a bet here. And I feel like it was multi-causal. I think the valuations were, we ourselves are very, very conscious getting in early that we have to have certain, for us, thresholds. And if a company overvalues itself on day one, that is only going to be a recipe for disaster later on. And I think a lot of the pain now is companies that had raised in the sort of heyday of 2018, 19, 2021, and now going, oh Lord, I need to go and raise an extension or a down round, etc. And I think that's happening everywhere.
And the scale of growth of those businesses was just ludicrous.
Yeah,
as well, wasn't
it was, but you were looking probably at the wrong. The growth of what, right? Some of them was revenue. But
I'm talking about the headcount side of things.
Yeah, headcount. But then a lot of it was driven by looking at the wrong. There was a push for sort of take the neobanking area. There's right? There was a massive push on, yes, we're growing our signups, but signups aren't necessarily monthly active users, or the conversion wasn't happening through. And the spend of revenue, or the increase in revenue, was matched by an increase of losses.
Yeah, the smoke and mirrors.
So how sustainable were these businesses? Now, some of them really broke through, and you can say they can hold their own and be profitable. But for every one of those, there's about 8 or 9 which struggle.
Yeah.
So I feel like we got into a very big wave, and I think the market correction was necessary, but B, as you say, poses an opportunity to just recalibrate. I think there's going to be quite a bit of restructuring of certain companies. There's already quite a lot of acquihires going on, M&A opportunities higher. Strategic investors are coming into rounds now more because valuations are more reasonable, or they can see there's a path to an acquisition.
Absolutely.
We're seeing that across the board. So all of this, I think it was a necessary correction. And I think hopefully it's just making things a bit more sustainable in terms of value. So now people are not valuing things on 15, 20, 25 times, forward annualized revenue multiple at the growth stages on a B2C company, but more at like 5 or 6, right? I think that's a more reasonable thing.
I agree. And going into 2023, your confidence levels for the UK FinTech scene?
I think, we remain very bullish on it at our stage. I think, as you've said earlier, good companies will get funded, provided they weren't stupidly priced and haven't gone through it, and they continue to grow and deliver, they'll get their rounds away. We're seeing great new companies coming in, like the whole area of affordability now is another theme, which we're seeing great companies coming through on. So very bullish on that. I think on the wider UK macro story, we wait to see obviously how that plays out over the coming weeks. Regardless of that, FinTech will always be one of the UK's best exports, and we just need to keep ensuring that those companies can be funded, or good ones.
Yeah, absolutely. Yeah, absolutely. There's the key word. Final thing for you. Who should be getting in touch with you? You guys are doing some great stuff. There seems like there's a Goldfinger element to what you're doing there. Tell us who's interesting for you to talk to. Who can you help?
I mean, any founders looking to raise a 2 to 5 million, sort of had a proof of concept of some kind, had a bit of it, perhaps angel money or family and friends capital, looking for that next raise, who can feel that they're building something which is building a solution that really, really is necessary, please reach out to us. And I think, whether it's on our website or directly to us as a team, we have 2 team members focused just on deal flow and assessing those companies and to seeing those 70 or however many a month. So we're fully open for business.
I love that. Fully open for business is a great way to finish. It's been brilliant, fascinating. As I say, there's probably an episode 3, 4, 5
By all means.
and 2 to come into that as well. Really, really enjoyed it. Thanks so much for
thank you for having me
and chatting to us.
Brilliant. Cheers.
Really enjoyed it.
Thanks very much.
And thank you all for watching. We will see you soon on another episode of FinTech Focus TV. Thanks a lot.